On February 28th, President Trump initiated a conflict that triggered a market decline. Surging oil prices, an essential cost across farming, manufacturing, shipping, and AI, raised legitimate fears of recession or stagflation, pushing nearly all assets downward. Stocks declined, bonds declined, and precious metals and crypto followed. This raises a critical question. Why did everything fall when bonds and gold are considered safe havens? This is the key point to understand. The global economy operates on a debt-driven system. Consider sovereign or government debt. Around 25 years ago, global government debt stood near $20 trillion. By the end of 2025, it had surged to over $111 trillion. Because of this expanding debt structure, inflation becomes necessary. Prices are expected to keep rising. The current economic model depends on rising stock markets, increasing wages, and growing tax revenues to prevent the debt system from collapsing. Consider a simple example that anyone can understand. Imagine buying a house with a $300,000 mortgage while earning $100,000 a year. Keeping the numbers simple, this level of income allows the monthly mortgage payments to be managed comfortably. However, if income drops to $70,000 a year, the situation becomes strained, and keeping up with those payments becomes significantly more difficult compared to when income was $100,000. On the other hand, if that same $300,000 mortgage is paired with an income increase from $100,000 to $150,000 a year, managing the payments becomes much easier. The reason is straightforward. Income has increased while the existing debt remains unchanged, improving the overall financial position. This reflects a broader economic principle. With large amounts of debt in the system, higher income levels, rising prices, and increased tax collection all play a role in maintaining the ability to service that debt. Now, it is important to understand that the surge is not limited to government debt. Mortgage debt, auto loan debt, credit card debt, and student loan debt have all been rising sharply. This comes as no surprise. The chart being referenced extends through February 2026 and highlights margin debt, borrowed money used by investors to invest. In simple terms, it involves investing with borrowed capital. For example, consider a brokerage account with $1 million. That amount allows the purchase of $1 million worth of stocks. However, additional funds can be borrowed, such as an extra $300,000 to invest beyond the original capital. If market growth were guaranteed, borrowing to maximize investment would seem logical. However, such certainty does not exist in short time frames due to volatility and unpredictable events. Consider an investor who borrows a significant amount of money to invest. In this situation, the outcome remains the same. Investment prices must rise. Otherwise, debt problems begin to surface. If investments remain flat and show no movement, losses occur through ongoing interest payments on margin debt. If investments decline, the situation becomes more serious, especially with high borrowing. When market conditions shift and prices fall, these borrowed investments start losing value. In such scenarios, what options remain? Many investors are forced to sell. They sell their positions because there is no alternative, aiming to reduce or eliminate margin debt. Ultimately, the objective becomes clear: securing cash to stabilize and protect their investment accounts. When money is borrowed within a brokerage account and margin debt increases, a specific balance must be maintained. If that balance is not met, the brokerage automatically sells positions to ensure the borrowed funds are repaid. This situation is known as a margin call. When markets drop quickly, margin calls increase, forcing investors to urgently search for cash. To obtain that cash, assets are sold based on what can be liquidated quickly, not what is preferred. For example, if someone owns a rental property and physical gold and receives a large margin call requiring funds within 48 hours, the choice becomes clear. Selling a property in that time frame is unrealistic, while gold can be sold immediately. As a result, the gold is sold, because the priority is speed, not preference, leaving no real alternative. Investors, institutions, and countries began selling stocks, gold, and U.S. Treasury bonds across all asset classes to obtain cash. A liquidity crunch triggered a widespread sell everything environment. This situation is being observed during a temporary 2-week ceasefire. If the conflict truly de-escalates and the liquidity crunch eases, reducing the need to liquidate assets for cash, the system is expected to return to its underlying trajectory, expanding debt, rising investment prices, and increasing inflation. This process is not speculative. It follows a structured mathematical design. A prolonged recession or deflation cannot be sustained within a debt-driven system. The numbers simply do not support it. Even if such conditions emerge, they are unlikely to persist, as monetary intervention, such as money printing, can reverse recession or deflation within months. However, these measures carry long-term consequences, leading to inflation and potentially hyperinflation. Despite this, the system prioritizes short-term stability. Agreement with this economic structure is not required, but it defines the current environment, and adapting to it remains essential to avoid financial disadvantage. Now, the focus shifts to how investments should be approached in 2026, particularly in the event of de-escalation in the Iran conflict and a return to a normal market trajectory, which remains inevitable. The first priority is to stay invested, avoiding attempts to time the market by moving in and out. Short-term trading is discouraged, while a long-term investment mindset remains essential. Market dips should be used strategically. Periods of volatility present opportunities, as long-term market behavior is structured toward upward growth. These declines act as entry points rather than signals to exit. Instead of trying to identify the perfect bottom, a consistent dollar-cost averaging approach should be followed to remove uncertainty and maintain disciplined investing. The best price may not always be achieved, but the worst outcome is also unlikely. During a dip, it presents an opportunity to buy at a discount. However, one critical point must be emphasized. Borrowing excessive amounts of money to invest creates significant liability and unnecessary financial stress. This is how many smart individuals fall into financial trouble. Excess margin debt should be avoided, and diversification must be maintained. An S&P 500 index fund, or ETF, remains a core component of a balanced portfolio. Concentration in only U.S. stocks carries risk. Exposure to international stock funds, or ETFs, along with assets like gold and silver, plays an essential role in building a well-diversified portfolio for 2026 and beyond. Looking at long-term data provides clarity. The M2 money supply over the past 60 years shows a consistent upward trend with clear acceleration. This expansion explains why inflation persists and why prices, including investments, continue to rise. There is simply more money in circulation. The performance of the S&P 500 over the past 30 years reflects a similar pattern, steadily increasing over time. This growth is driven by the same underlying factor, an expanding money supply, which helps sustain the broader financial system. Gold prices over the past 30 years also follow this trend, continuing to rise steadily. The pattern becomes evident when observed closely. The reason is now clear. It simply takes more devalued dollars or devalued fiat currency to buy an ounce of gold. Over time, gold has significantly outperformed the S&P 500. The blue line represents the performance of the index, which can be directly compared to the performance of gold. Including gold in a portfolio is not an irrational decision. In fact, based on historical performance, excluding it would be difficult to justify. This overview highlights only the surface of a broader discussion focused on investments, idea evaluation, and positioning for what lies ahead.